futures day trading. In trend following strategies in futures trading, traders identify the direction of the market trend and make trades in that direction. This might involve buying in an uptrend or selling in a downtrend, often using technical indicators to identify these trends. What is the primary objective of trend following strategies in futures trading? The primary objective of trend following strategies in futures trading is to capitalize on market trends. These strategies aim to identify and follow significant directional movements in the market, whether upward or downward, to generate profits. The primary goal of trend following strategies in futures trading is to capitalize on sustained market movements. Traders aim to identify and follow significant market trends, buying in uptrends and selling in downtrends. This strategy is often chosen by traders seeking capital appreciation through market momentum. How do trend following strategies adapt to different market conditions? Trend following strategies are ideally suited for trending markets. They adapt by focusing on long positions in rising markets and short positions in declining markets. However, these strategies may face challenges in sideways or highly volatile markets where clear trends are less apparent. Trend following strategies are most effective in markets that exhibit clear and sustained trends, whether upward or downward. They are particularly well suited to volatile markets where trends are more pronounced and can be leveraged for significant gains. These strategies may not perform as well in sideways or highly erratic markets where clear trends are harder to identify. What is the risk profile associated with trend following strategies? The risk profile of trend following strategies involves managing the risks of trend reversals. These strategies may be exposed to potential losses if a market trend unexpectedly changes direction. Effective risk management techniques such as stop-loss orders are crucial to mitigate these risks. While trend following can be profitable, it comes with the risk of sudden trend reversals, which can lead to losses, especially if the trader is unable to exit the position promptly. The maximum potential loss can be significant if market trends shift unexpectedly and positions are not managed properly. Traders need to have a clear risk management strategy, often using stop-loss orders to mitigate these risks. What potential rewards can be expected from trend following strategies? The potential rewards from trend following strategies come from gains achieved through sustained market movements. By riding long trends, these strategies can accumulate significant profits, especially in markets that exhibit strong and prolonged directional trends. The reward potential of trend following in futures trading lies in capturing the gains from large, sustained market movements. The best case scenario is entering a trade early in a trend and riding it to its culmination. However, traders should also have realistic expectations, as not every identified trend will result in large profits, and the average expected return may vary based on market conditions and the trader's timing. What are the key steps and considerations in implementing trend following strategies in futures trading? Key steps and considerations in implementing trend following strategies include identifying trends and determining optimal entry or exit points. This involves analyzing market data to spot emerging trends, deciding when to enter and exit trades, and continuously monitoring market conditions to adjust positions as needed. To implement a trend following strategy, traders typically use technical analysis to identify potential trends. Key steps include choosing the right futures contract based on market analysis. Using technical indicators like moving averages, moving average convergence divergence, or relative strength index to identify potential trends. Determining entry points when a trend is confirmed and setting exit points or stop loss orders to manage risks. Monitoring the position closely and being prepared to exit if the trend shows signs of reversing. Traders also need to consider factors like contract expiry and rollover when trading futures.